Hi, this is your instructor, Craig Pence, and in this video we'll be looking at the corporate income statement and the way that generally accepted accounting principles require corporations to report income and expense items. We have an example here in which the corporation is subject to a 30% tax rate. The company has 1,000 shares of 2% preferred stock outstanding and 10,000 shares of common stock. We'll need this information later because corporations are required to disclose their earnings on a per share basis as well as in total. Our company has sales revenue of $100,000. The cost of goods sold is $50,000. Operating expenses, this would be the general and administrative expense along with the selling expenses, total $10,000. And then we run into something new. We have restructuring expense and fixed asset impairments, along with discontinued operations and extraordinary items. These are all new things that are being presented in this module for the first time. A restructuring expense occurs when a corporation undergoes a major restructuring effort. Often, many employees lose their jobs and have to be awarded with severance packages. There are other costs associated with undergoing significant changes in the way the corporation is going to function in the future. These things are all combined together and are labeled a restructuring charge and placed on the income statement. A fixed asset impairment occurs when a corporation's asset loses value permanently. This could be because of obsolescence, changes in business conditions, or of significant damages. When an asset loses its value permanently, then the corporation writes the asset down to its current market value and records a loss, and that would be labeled a fixed asset impairment on the income statement. Other income and expense represents income and expense from peripheral kinds of activities, not the corporation's major ongoing business operations. Things like interest income and interest expense would be reported here, and so would gains and losses from the sale of machinery or buildings or short-term investments. These things would all be reported as other income and expense. Discontinued operations refer to a major segment of the business that has been discontinued during the period. This could be a division of the company or a major product line or something like that. And when the company disposes of it, usually by selling it off, then we'll have something to report as a discontinued operation gain or loss. Extraordinary items are gains and losses that come from events that are both unusual and infrequent. Unusual means that the event is something that's not part of normal business operations. Infrequent means that the event is probably not going to happen again. These are two pretty strong tests, and it's not very common to see a corporation report an extraordinary item. Here's our corporation income statement set up in format. And you can see that we have the sales figure listed at the top of the statement, of course, and then cost of goods sold, and then gross profit. After determining gross profit, we list the operating expenses of the business. These would be the selling and the general administrative expenses. But if we have restructuring charges and fixed asset impairments to report, they're combined with the operating expenses, and we then subtract the total amount to get income from operations. Income from operations has an obvious meaning. This is what the company was able to earn from its ordinary, ongoing central operations. If there are any revenues and expenses that did not come from normal operations, then they're listed next as other income and expense items. We'll subtract them in this case, since the total was a negative amount, to determine income from continuing operations. Generally accepted accounting principles require that if our company has discontinued operations or extraordinary items, they have to be reported separately from income from continuing operations. Now, if we didn't have these two things to report, this would simply be net income before taxes. But since we do have them, we'll have to label this line income from continuing operations. Generally accepted accounting principles requires that income from continuing operations be stated on an after-tax basis as well. So given a 30% tax rate, we would have $9,000 to pay in taxes on the $30,000 of income, and that would give us $21,000 for income from continuing operations on an after-tax basis. Well, why do all this? We're required to state discontinued operations and extraordinary items separately from income from continuing operations simply because these things will probably not happen again. An investor who's interested in forecasting profits for next year isn't going to be looking at this bottom line number of $27,300. It's this $21,000 that's likely to recur next year. The other things that did affect income this year are now going to be reported below the income from continuing operations number. That would be the discontinued operations and the extraordinary loss. In this case, we had a gain from discontinued operations. And under generally accepted accounting principles, all items after income from continuing operations need to be stated on an after-tax basis. This is something that's referred to as intra-period tax allocation. Well, if the discontinued operations resulted in a $15,000 gain, then this would be taxable, and our corporation would have to pay taxes at a 30% rate. So $4,500 would have to be paid in taxes, which means that after taxes are paid, our corporation would only have $10,500 of the gain left. The extraordinary loss is $6,000, and losses also create a tax effect, though it's not as obvious how it is they do or why they do. Let's take a look at a brief example that will clarify this. Here we have a taxable revenues of $100, but we also have a deductible expense of $100. When you do your tax return, you're able to subtract deductible expenses from the taxable revenues to determine what your taxable income is. It's the taxable income that we all have to pay taxes on. In this case, since our taxable income is zero, we'll have no taxes at all to pay. However, we did have $100 in taxable revenue, and if we didn't have the deductible expense, then we would have to pay taxes on it, and that amount would be $30. The reason our net tax expense is zero is because the deductible expense also created a tax effect. Because we had the expense, we saved the $30 in taxes that we would otherwise have to pay on our taxable revenues. Taxable revenue creates additional tax expense, but a deductible expense creates a tax savings. And in this case, the tax savings exactly offset the tax expense. So net, we had no taxes to pay. Let's go back to our income statement. And the fact that we had a $6,000 loss that would be deductible on the corporate tax return means that we'll create $1,800 in tax savings. That's just 30% of the $6,000. So net of tax savings, the loss only costs the corporation $4,200. When we total it all up, our net income figure on an after-tax basis is $27,300. Now remember, an investor understands that it's the income from continuing operations that is likely to recur next year. And this $10,500 gain and the $4,200 loss are one-time events that won't happen again next year. So even though our corporation had $27,300 of income this year, next year we should expect that the corporation will have an income figure that's closer to the $21,000 that we have this year. Corporations are required to state the earnings on a per-share basis. And when we do have income from continuing operations, generally accepted accounting principles requires that that amount be stated on a per-share basis. To calculate earnings per share, we need to subtract the preferred stock dividends that would be paid to preferred shareholders out of these earnings from the total amount. Since this is earnings per common share, we're trying to tell the common stockholders how much the corporation earned for them on each share of stock that they own. We'll need to net out the preferred stock dividends since the common stockholders will not get that. We then divide by the number of common shares that have been outstanding on average through the year. In our case, 10,000, and that gives us $1.90. Now remember, it's the income from continuing operations that's likely to recur next year, so stockholders should expect the $1.90 to be more like what the corporation will earn next year for them, rather than the bottom line figure of $2.53. To get this, we do the same thing that we just did, except we use bottom line net income, and after we subtract out the preferred stock dividends and divide by the number of shares on average outstanding during the year, we'll get the $2.53. Discontinued operations and extraordinary items are also stated on a per share basis. When we add all these numbers up, we'll get our bottom line earnings figure on a per share basis. Earnings figures are extremely important to investors, and here we are looking at the General Electric Company's stock quote. We can see that General Electric closed at $34.37 per share on February 15th. One thing that's reported is the earnings per share figure of $2.17 per share. The price-earnings ratio is also reported, and the PE ratio is calculated by taking the current price per share, $34.37, and dividing by the earnings per share. As explained in the module, a high PE ratio usually means that the company is expected to grow quickly. Therefore, investors are willing to pay a high premium above current earnings per share for that stock. A stock that doesn't have great growth prospects will probably have a low PE ratio. We also see the dividend yield here. The annual dividend of $1.24 divided by the current market price, $34.37, gives us the current dividend yield, in this case 3.6%. The reason all this information is available to us in such an easily accessible format is because it is so relevant to stock market investors. What the corporation reports on its income statement is fundamentally important in determining the company's stock price and its ability to raise new financing by issuing additional shares of stock to stockholders. That's why there's so much attention paid to the income statement in generally accepted accounting principles, and why our chapter and module here have so many complicated topics in them. Well, this concludes our video, and I hope it's been helpful to you.